Economist by training, he first joined the Bank of Canada in 1981 and occupied a range of increasingly senior positions over a 14-year time span. Mr. Poloz then spent 4 years at BCA Research as managing editor of its flagship publication, the International Bank Credit Analyst. Mr. Poloz joined Export Development Canada in 1999 as vice president and chief economist. From 2008 to 2010, he was responsible for all of EDC's lending programs, as well as the economics and corporate and international trade intelligence groups. He became EDC's president and CEO in January of 2011, a position he held until his appointment at the Bank of Canada. Mr. Poloz resides in Ottawa with his wife, Valerie. He has 2 children, Jessica and Nicholas, and he is also a grandfather. Please join me in welcoming Governor Poloz.
Well, thank you very much, Sue, and good morning. Bonjour tout le monde. It's lovely to see all of you out here today. Of course, today will just be another one of those quiet days in the market. Yes, it's really cool to have this tradition to come down to Toronto at year-end, always to have a few words. This is my last speech of this calendar year, and so just in case I forget, I just want to mention that the Bank of Canada was named Central Bank of the Year for 2018. Okay. And by the way, that was before we did this. Okay, which is really sweet. Thank you. Anyway, today we're going to combine 2 traditions, one old one and one relatively new one. The older tradition, which I just mentioned, it goes back more than a decade. Sees the Bank of Canada governor come down to Toronto, talk about the state of our financial system in a year-end speech. And the newer tradition, which only started earlier this year, is to offer an economic progress report 4 times a year, following the interest rate announcements that come without a monetary policy report, like yesterday. So my motivation for combining these 2 traditions is more than just trying to raise productivity, which of course would be a good thing. But 10 years ago, the financial crisis gave us the preconditions for a repeat of the Great Depression of the 1930s. But thanks to aggressive fiscal and monetary policies, we avoided it. But a decade of massive monetary stimulus has brought us to a critical phase in the economic cycle. The Canadian economy, well, it's been operating near its capacity for over a year now. Unemployment is at its lowest in decades, and inflation is on target. Now, historically, this is the point in the business cycle where inflation pressures can start to build. So it's natural that we are looking to move interest rates to a neutral level. At the same time, the decade of exceptionally low interest rates has led to a buildup of household debt, of course consisting mostly of mortgages. And we're all aware of large increases in house prices in recent years, particularly in some of our largest cities. Now, these financial vulnerabilities have made monetary policy more complicated. Understanding them and integrating them into our policy process has been a priority for us at the bank. Well, meanwhile, the world has not stood still since our last MPR in October. Indeed, there have been more macroeconomic developments than usual in this period. So my focus today is to bring you up to date and to set out how financial stability concerns are captured in our decision-making process. So let me start with a few words about how our financial vulnerabilities became so large to begin with. I mean, the fact is that debt builds up during the recovery phase of every economic cycle. Low interest rates stimulate a recovery by encouraging households and firms to borrow. Now, normally, the economic cycle is short enough that the risks posed by these imbalances are relatively minor. But of course, the past 10 years have been far from normal. Interest rates have been extraordinarily low for an extraordinarily long time. The inevitable result has been strong demand for housing, rising house prices, and an accumulation of household debt of historic proportions. Now, the associated buildup in financial vulnerabilities has been a preoccupation of the bank for several years. Indeed, household indebtedness in Canada was rising strongly long before the global financial crisis. This was mainly as a result of an easing of mortgage rules some 15 years ago, along with some financial innovation and, of course, declining interest rates. Now, in response to these developments, the federal government has implemented a series of more restrictive macro-prudential policies designed to ensure that new borrowing is safer. And in particular, with the revised B20 guideline that came into effect earlier this year, all new mortgage borrowing from federally regulated institutions became subject to some form of stress test to ensure that borrowers can handle an increase in interest rates. Now, you can find a lot more detail about this and other stability issues on our brand new Financial System Hub on the bank's website. Well, now, I hear all the time from people who say that this stress test should not apply in housing markets that have not been overheating. But the point of the change to B20 was not to cool housing markets. The point was to increase the future resilience of new household debt. All Canadians face the risk of higher interest rates, not just those in hot housing markets. Well, still, there's no doubt that the combination of these stress tests and higher interest rates and housing policies put in place by provincial and municipal governments are affecting household borrowing. We're seeing far fewer mortgages being taken out at debt-to-income ratios over 450%. And credit data show that mortgage borrowing growth has slowed this year to a rate of just over 3%. So at that rate, the aggregate debt-to-income ratio is likely to establish a moderate downtrend. Now, in setting monetary policy, it's crucial for us to disentangle the impacts of these various policies. We need to know how much of the slowdown in credit growth is due to higher interest rates rather than to the other policies. How large is the impact of higher interest rates on household spending? And how are various macroprudential policies, including B20, affecting the behavior of borrowers and home builders? Now, clearly there's no way to get precise answers to these questions. But we need to understand how developments in the financial system affect the real economy and the risks that it faces. Now, I spoke on this topic almost 4 years ago during a lecture at Western. I talked about the idea of developing a grand synthesis, a utopian economic model, capturing all these linkages, how the financial system would affect the real economy, vice versa, and helping us to deliver on our inflation control mandate. Now, we may never reach that utopia, but the good news is that we've made significant progress. So I want to mention 3 important improvements. Now, first, a new concept that was developed at the IMF, it's called growth at risk, is now being used by bank staff to help us understand the links between the financial sector and the real economy. What it does is it captures the rise in financial vulnerabilities and the downside risks to economic growth associated with them. So when contemplating a change to interest rates, we can estimate both the usual direct effects on the economy as well as the indirect effects through the financial vulnerability channel. So this growth at risk framework, it's not a grand synthesis, but it does give us a more rigorous way of thinking about financial vulnerabilities within our risk management policy framework. The second thing we've done is we've upgraded our main economic model to incorporate household debt accumulation, and therefore to capture the fact the economy is more sensitive to interest rate movements when debt levels are high. It also embraces the link between that debt accumulation and rising house prices. Now, these are important steps to help us understand the impact of these vulnerabilities on the economy. The third thing is that bank staff are working with new sources of microdata to deepen our understanding of how higher interest rates affect mortgage holders. We now have access to anonymized data at the individual loan level, dating back to 2014, and covering roughly 85% of mortgage borrowing over this period. So this includes information like mortgage size, household income, the interest rate at origination, the mortgage term, and the amortization period. So these data allow us to calculate how households are being affected by higher interest rates through that entire mortgage renewal cycle. And by estimating the effects of higher rates on monthly household expenses, we can then forecast how spending on other purchases will be affected. So far, this enhanced framework has performed well for our forecasters. However, it's important to remember that to date, most households have been renewing at mortgage rates that are pretty similar to the rates that they signed up for 5 years ago. But as we go forward, people will increasingly face higher interest rates when they renew, both because they're higher, but also because the one they signed up for was lower. And we'll learn more about how people are adjusting. So it's clear that many highly indebted households will face a difficult adjustment as their mortgage reset and interest rates go up. But still, such adjustments will be far less demanding than if there were a serious negative economic shock, especially if financial vulnerabilities were allowed to continue to grow unchecked. Now, the fact that household spending is behaving roughly as expected gives us more confidence that we understand what is happening in the economy. But borrowers and lenders are continuing to adjust to rising rates and the new mortgage rules. So we're closely watching a number of trends in the mortgage markets. So for example, the share of mortgages that originate outside of federal jurisdiction, including from private lenders or credit unions, is rising. So these borrowers are not subject to a formal interest rate stress test. Now we've seen a rise in the share of mortgages issued by private lenders in the Toronto area, for example, and although we don't have this type of data for cities outside of Ontario. We've also seen a greater share of highly indebted borrowers taking out variable rate mortgages. Now, in doing so, they may be lowering their debt service burden because usually the interest rate on a variable mortgage is a little bit lower than the one on a fixed mortgage. That frees up some money for spending or for saving in the short term. But it also exposes the borrowers to unexpected increases in interest rates down the road. With that all said, the stress test in place gives us more confidence that these borrowers can manage significantly higher payments if need be. So in summary, while the quality of new lending has improved, the outstanding stock of risky mortgages remains high. And over time, those mortgages should become less risky as they're slowly paid down. But this vulnerability will persist for many years. Now, closely related to the buildup of household debt are developments in housing markets. Everybody's talking about this issue. I mean, it's no surprise when you see that house prices in the Toronto area are close to 40% higher than they were just 3 years ago. In the Vancouver area, the increase has been even larger, about 50%. Outside of those two areas, the average home price has increased just 5% over the same 3 years. To be clear, fundamental factors have pushed up house prices in Toronto and Vancouver. Strong population and employment growth has supported housing demand. The cost of several inputs, such as construction labor and development fees, has also increased. At the same time, various policies and other factors have limited supply growth in both places. And if supply does not expand in a climate of strong demand, you have a recipe for rising prices. That said, it seemed clear to us that the price growth was being magnified by speculative activity, particularly during 2016 and 17. Now, some buyers were accelerating their purchases, motivated by fear that they would be priced out of the market if they waited. Others, primarily investors, were buying real estate on the assumption that prices would keep rising. So this is significant because when speculative activity drives prices unsustainably higher, an economic shock can prompt a sharp decline. Now, anyone who remembers the housing market of the early 90s in Toronto and in Vancouver will recognize this point. Now, the impact of such a drop is magnified when the homeowners are also highly indebted. Now, the bank has raised the key policy interest rate 5 times over the past year and a half by a total of 125 basis points. And I've heard from some Canadians, more so lately, who are concerned about the impact of these rate increases on housing affordability. However, given the combined impact of provincial and municipal housing measures and tightened macroprudential policies, not to mention higher interest rates, house prices for Canada as a whole are now growing at an annual rate of roughly 2%. It seems to me that this slowdown in house price inflation is much more meaningful in terms of affordability for first-time homebuyers than the interest rate movements that we've seen. The basic laws of economics tell you that measures to increase supply of housing would be the most effective way to support affordability. And measures that increase demand with no corresponding increase in supply could make housing affordability worse. Now, speaking of the uptrend in interest rates, a related risk to Canada's financial stability that we've been watching closely is that of a snapback in global interest rates. But because Canada would typically import something like 60 or 70% of any rise in global bond yields, we would see the attendant effects on our mortgage rates, even if the Bank of Canada policy rate was held unchanged. So this risk remains top of mind, particularly given bond and equity market volatility in recent weeks. Now, most observers would contend that the likely catalyst for such a risk would be some inflation surprise coming from the U.S., and the probability of which has risen with the response of the U.S. economy to fiscal stimulus. However, our outlook remains that the U.S. economy will moderate to a more sustainable pace next year and into 2020, and that inflation expectations remain well anchored. So let's sum up the financial stability situation. The Governing Council judges that the overall level of risk to the Canadian financial system is about the same as it was 6 months ago when we published our financial system review. New mortgage borrowing is more sound, and house price growth has decelerated. Nevertheless, the stock of household debt will stay high for years, and house prices remain elevated in certain markets. Our new growth at risk framework shows clearly that macroprudential policies have worked to mitigate financial stability risk, thereby improving the risk management problem faced by monetary policy. So let me turn now to the macroeconomy. So as we said in October, the economy has been operating close to its capacity for more than a year, and inflation's on target. Well, since October, though, there have been a number of important developments. First of all, there have been growing concerns of a global economic slowdown. I would note that our forecasts were already calling for a moderation of global economic growth in 2019 to 20. But this moderation would only bring us to a more sustainable growth track and would not be cause for concern. Nevertheless, the main risk that we see to that outlook today is the ongoing trade tensions between the U.S. and other countries, particularly China. Now, rising tariffs will slow economic growth and reduce productivity on both sides. A combination what comes with rising inflation risk. Now, this combination we used to call stagflation. This is what trade wars present to us. This combination is particularly challenging for monetary policy, since it forces a trade-off between cushioning economic growth through lower interest rates and containing inflation risk with higher interest rates. Now, because the effects on the economy would likely prove to be structural rather than cyclical, I have to believe that containing inflation risks would become paramount in an outright trade war. Now, importantly, the risks around global trade are two-sided. Yes, there is growing evidence that trade actions are already having negative macroeconomic effects. But as central bankers, we cannot focus only on that worst-case scenario. The upside risk is that the U.S. and China come to terms, and the global economy enjoys a new source of lift. So events this past weekend in Buenos Aires were somewhat encouraging on this front. So we continue to weigh both sides of this issue for policy. But in terms of the Canadian economy, it's fair to say that the data released since our October NPR have been on the disappointing side. While the GDP data for the third quarter were very close to our expectations overall, the underlying composition of growth was not. And the economy has less momentum going into the fourth quarter than we believed it would. While recent data from the housing sector have been softer than expected, well, we believe this is the result of a significant adjustment in new construction from single dwellings to multiples. And this adjustment has prolonged the slowdown in housing construction that began earlier this year. Population and employment growth, and therefore fundamental demand for housing, remain strong. Credit growth has also steadied, and all of this supports our view that the market is stabilizing. But business investment unexpectedly declined in the third quarter. Now, we'd identified earlier this year the likelihood that uncertainty over the future of NAFTA would hold back investment decisions. It now appears that this effect was very strong during the summer when uncertainty was at its peak. The other big factor restraining business investment was the delay in the Trans Mountain Pipeline project. Now, the signing of CUSMA, or the new NAFTA, is likely to support a rebound in investment, particularly given ongoing capacity constraints, although governments still need to implement that agreement. And furthermore, the federal government's recently announced tax changes will lead to a further strengthening in investment. This would also suggest continued growth in exports, which have been supported by strong foreign demand but constrained by tight capacity. In its latest GDP release, Statistics Canada also revised downward its historical estimates of economic growth. Now, most of these revisions pertain to shifts in economic structure beginning in 2015, as the economy was adjusting to the steep decline in oil prices. Now, it may seem odd that developments in 2015 could still be affecting our view of the economy in 2018, but they do. The level of GDP today is now believed to be nearly 1% lower than previously thought. The effect of this revision on the inflation outlook will depend on how much of that shift is in demand and how much of it is in supply or economic capacity, and therefore how our estimates of the gap between the two are affected. Now, we'll say more about this in our January NPR once our analysis is complete. But much of Governing Council's discussion for our interest rate decision this week was focused on oil. Now, global oil prices are well below our forecast assumptions that were made in October, primarily due to supply forces. Yes, there's also an important overlay of worry about moderating global economic growth given heightened trade tensions with implications for future oil demand. But the main source of additional oil supply is the same as it was back in 2014. That's the United States. For reference, the world consumes about 100 million barrels of oil per day. Now, back in 2008, U.S. production was about 7 million barrels per day. By 2014, the shale revolution pushed that figure up to 12 million. And today, U.S. oil production is over 15 million barrels per day, more than double the 2008 level. That's 2 million more than just a year ago. And U.S. exports of oil have risen by the same amount over that time. Now, these U.S. developments absolutely dwarf Canadian production. We produce about 5 million barrels per day and export just over 3 million. But weak global oil prices have a direct impact on Canada, of course, as we well know from our experience in 2015 to 17. Now, this affects all producers, east and west. And although the Canadian economy overall had largely completed its adjustment to lower oil prices by mid-2017, adjustments to cost structures and to wages and employment in oil-producing regions are ongoing. Indeed, the share of oil and gas production in the Canadian economy has declined since 2014, from about 6% of the economy back then to about 3.5% of the economy today. So the recent decline in world oil prices, though, has been magnified in Western Canada, as the discount applied to our heavy oil, which we call Western Canada Select, widened to a record. This is largely due to transportation constraints. We identified this in our October NPR. It was compounded this autumn by maintenance shutdowns in some key U.S. refineries. And since our October rate decision, sure enough, the heavy oil discount has declined as U.S. refineries have come back online. But in recent weeks, that discount has also spread to the price for Western Canadian light crude oil, Edmonton Par, because stored inventory has hit record levels. Now, Alberta's initiative to impose output reductions and to add more rail capacity are going to help clear that backlog. And more pipeline capacity would certainly help in the long term. Now, while we did not prepare a completely new economic forecast for yesterday's decision, we will do so between now and our next decision in January. But it's already clear that a painful adjustment is developing for Western Canada, and there will be a meaningful impact on the Canadian macroeconomy. Now, that said, given the consolidation that has taken place in the energy sector since 2014, the net effects of lower oil prices on the Canadian economy as a whole, dollar for dollar, should be smaller than they were in 2015. Well, summing up then, as I said, a lot has happened since our October NPR. But let's not forget that these developments have come against a backdrop of an unemployment rate at a 40-year low and inflation close to target, consistent with an economy that has been operating close to its capacity. So we'll assess all of these new developments and our new projections in the January NPR. Hier, le Conseil de direction a établi que le niveau actuel des taux d'intérêt reste approprié pour le moment. Et en raison de tous ces changements, nous pensons encore que le taux directeur devra augmenter. Bien entendu, le rythme de ce processus dépendra fortement des données. Governing Council determined yesterday that the current level of interest rates remains appropriate for the time being. And weighing all of these new developments, we continue to judge that the policy interest rate will need to rise into a neutral range, somewhere in the neighborhood of 2.5% to 3.5%, in order to achieve the inflation target. The pace at which this process occurs, of course, will remain decidedly data dependent. We'll continue to gauge the impact of higher interest rates on consumption and housing and monitor global trade policy developments. The persistence of the oil price shock, the evolution of business investment, and our assessment of the economy's capacity will also factor importantly into our decisions about the future stance of monetary policy. So it's time for me to conclude. So I hope I've shown you how financial vulnerabilities fit into our monetary policy discussions. We've made progress in thinking about these and other vulnerabilities and understanding the risks they pose to the economy. And I've also tried to give you a sense of the multiple issues that we're wrestling with in managing the macroeconomic risks facing the Canadian economy. Now, we will continue to manage these risks as we pursue our mandate to control inflation and promote the economic and financial welfare of Canadians. And I wish you all a very happy holiday season and all the best in the new year. Thank you. So it's time for the Q&A, and you're in charge, huh?
Yes. Can everybody hear me?
Yep.
Yep, okay. We already have some questions, but for those of you in the audience that would like to also participate, please fill out the card, hold it up, and somebody from the staff will pick it up. So here's a good one. Could you share...
We start with an easy one, maybe. Come on.
Just to keep things going on the right tilt.
All right.
Could you share your perspective on liquidity risk in fixed income markets and potential opportunities to address specific areas of concern?
Well, boy, you had to start with that, eh? Well, this is a subject of considerable interest to us. Anecdotally, we're going through a period where, liquidity is not as plentiful as it used to be, and we know central banks are adjusting balance sheets and so on. So these are contributing to that sense that liquidity is an issue. We have Lynn Patterson's here this morning. She's established the Canadian Fixed Income Forum. So I know if I get in trouble with this question, I know I'm okay. But this is a forum in which we consult with major fixed income players to consult, let's say, on an ongoing basis around this issue. And my sense of it is, and I'm going to look to Lynn as she nods sagely while I say this, that things are going okay, but we're alert to potential issues around that. The Bank of Canada is certainly being careful from its own part to ensure that they're not contributing to a shortage of liquidity in those markets. And so, yeah, anecdotally things can happen. They usually last about 30 seconds or something in the marketplace, and then you only hear about them because somebody tells you about them later. But anyway, I'm not treating it lightly. We are treating it seriously, and Lynn is in charge of that. And if you have any follow-up questions, she's right there.
Governor Mark Carney recently gave a talk in Toronto where he discussed the risk of an Engel's pause, whereby there would be a painful adjustment due to the next wave of machine learning and automation technologies. Is the Canadian financial system ready for such a scenario?
I think the Canadian financial system is ready for anything. We face things today that look like unknowns to us, but if we just take a look at some of our history, you'll discover there have been events not unlike those over and over in history. When you compare how many resources we dedicate to food production in Canada today compared to 50 or 100 years ago, there's a massive change in that. I mean, how many resources we dedicate to oil or gas extraction compared to even 20 years ago. These things are changing all the time, and I think it's too easy to get discouraged or to be concerned about something big that's about to happen just because it sounds new and different. But actually, technologically, we've been faced with technological change steadily our entire lives. Certainly, I'm one of the oldest people here, so I can say that. But it's every time what has happened is that the economy has moved on to the next thing. And in fact, the technological change has each time throughout economic history created more jobs than it has destroyed. The process of creative destruction always includes destruction. That's the essence of it. But it's the creation part which is always bigger than the destruction. Yes, it gives rise to painful adjustments to people. I understand that. And it's important for us to have the safety nets in place to allow that transition to take place. But I would say, for instance, that right now we know there's over 500,000 job vacancies in Canada. And if I went out on the street and asked somebody, where do they think those vacancies are, they'd probably say they were for computer coders. And lots of them are, actually. But easily half of them are in very traditional sectors. Because when you create more, you create the demand for everything, not just for technological products. So a successful technology company generates incomes, and those folks all buy houses and cars and go out to eat in restaurants. They do all the normal things that everybody does. And so that part of growth creates jobs in traditional sectors. And so a lot of those vacancies are in construction or building maintenance or things that where the skill sets are not that far transportable from manufacturing type jobs that may face the kind of risks that Sue's talking about. So I refuse to get gloomy about that. I mean, I get it that it can be hard adjustment, but there's always something better coming for us. So we need to keep our eye on that. That's a good question.
Okay. Here's another one, and it's come in from a number of different sources.
Okay.
What current research supports the fact that 2.5 to 3.5 is the neutral range? That's something you could share.
Yeah. So there's a lot of research on that, and I think it's important to understand that when I say 2.5 to 3.5, it sounds like a statistical range. Like when I say if the economy is going to grow, between 2 and 3 or something, that sounds like a statistical range. But 2.5 to 3.5 is more of a methodological range. So certain research methodologies would point to something lower, in the sort of 2.5 zone, and others point to something that's higher. And within those things, there's still the statistical uncertainty that any economist brings to the table, which they hardly ever mention. But, fact is that when we say something's 2.5, we really mean there's a range around that from the statistical work we've done. So this is mostly global research because, for the most part, our equilibrium interest rate, the neutral rate, is mostly driven by international developments because it's the global demand, the investment savings imbalance or balance that gives rise to this interest rate. Demographics are an important variable. The long-term growth rate in the economy are important. And our rate would be a little different, let's say, from another economy, but only because of the local factors. But the base is the same. And so it's not an accident that the U.S., the Federal Reserve, says that their notion of the neutral rate is also 2.5 to 3.5, because we're all doing similar research and getting similar answers. But the fact is, we won't really know what neutral is until we're there. And the way we'll know is because it'll be a rate that is neither stimulating nor slowing the economy. That's what we really mean by a neutral rate. And we know that there's certain things about today's environment that are different from in the past. And I've talked a lot about, the legacy of debt today. And so if the economy is more sensitive to debt and therefore to interest rates today, then that may be around the margins affecting what that range is. So we confess that we're uncertain about this. We don't want it to sound like we've gone out the back and engraved 2.5 to 3.5 in a rock somewhere. But we know it's somewhere up in that area, and we're going to approach it carefully and monitoring really carefully how the economy is responding as we go along. And we're not alone in this. Other central banks face exactly the same issue because we've all been in this together for the last decade. And while we've been in it, the world has changed. So you just have to sort of stay tuned on that. But believe me, if you go to our website, you can come up with half a dozen articles that, support where all that research comes from.
Here's another popular theme as well. A lot of questions are coming in about the inversion of the yield curve in the U.S.
What inversion of the yield curve?
Very slight. What would your thoughts be on the shape of the yield curve?
So I gave a speech just 4 weeks ago in London on what markets were telling us, and I think that's still worth taking a look at. The markets have been a little wild lately, but what we're trying to discern there is to what degree is market action consistent or not consistent with our outlook, which is what we do all the time. And so it's certainly a habit of mine to spend my first part of my morning, going through my screens and saying what's going on out there that doesn't make sense to me. And if it doesn't make sense, then I'm asking more questions about what the economists are saying, right? So that's just natural. And for sure, the yield curve, the fact that it's been flat and it actually has flattened, which is a lot different, by the way, from inverting, is a signal that, as I said 4 weeks ago, it's a signal that we would ignore at our peril because it has a very long history of telling us something important about the economy. There are factors out there which would lead you to put extra caveats around interpreting the yield curve today, and they're related to this past 10 years. I mean, the world has not stayed the same as it was before. So that's true, but of course not dismissing the warning that it's giving us. So it's one of those things that keeps us cautious about how we're moving here, because it's true that the yield curve should tell us something when it changes. By the way, the fact that long rates have come up off their floor is, indicative of the fact that the massive monetary stimulus the last 10 years is drawing to a close. It doesn't mean it ends like a cliff. It means it gradually comes to a close. And as that happens, you would expect a re-rating, a recalibration of where stock markets should be. So you'd expect to see higher volatility because you've moved risk back out into the marketplace off of the balance sheets of the central banks. And when you layer on top of that, the trade war, what you'd expect to see is volatility from that, both macro and in sectors. And sure enough, you can see like this week, we have a great day Monday and we have a bad day Tuesday. Well, that's perfectly correlated with that risk of the China-U.S. trade war. And if you look underneath, you'll see that most of the damage is in stocks that are exposed to trade, and that ones that aren't are not really being damaged. And so all that to me kind of fits together. There's a moderating global economy, yes, check. Expect that. Higher long-term interest rates, check. A recalibration in stock markets, check. Strong U.S. dollar, check. All those things are exactly what I would predict from our basic outlook. So nothing inconsistent there. It doesn't mean we can't have a crazy day and wonder what that means. But today, it's got to do with, again, China-U.S. relationship, and where does that all take us? So let's all knock on wood about now.
So this will be our last question.
This will be our last question. Yes. It's probably going to be a real hard question.
Again, I've had some themes on this as well, and you've touched on it a little bit, Governor. What impact does changing demographics and aging populations have on Bank of Canada policy and direction for setting targets?
Well, for me, demographics make me think about retirement. I don't know about you. But but seriously, the most important manifestation of this is actually easy to lose sight of what we've been through. If you can look at a demographic chart which shows just the age distribution for the economy, what you have is this huge run-up in the growth of the population. We call that the baby boom period, right? So you have this huge run-up in population growth, and then kind of a plateau which lasts for 50 years. And then it begins to slide down the hill. So of course, 50 years, even I think that's a long time. So that just becomes what you think is the trend line in life. But actually, in the long sweep of history, it was an extraordinary 50-year period. We have to get used to in our heads that it was the 50 years that was unusual, not today that's unusual. Okay, we're going back to a more normal demographic trend line. So as the baby boomers retire and they fall out of the workforce, hopefully they're still with us a long time, but the point is they're going to be as much in the workforce. And so what happens is the engine of economic growth for that 50 years was that baby boom. And so we got used to trend lines that were 3% or sometimes even 4% for economic growth. Now we're looking at trend lines that are more like 2% for economic growth. Why? Because there's fewer people fueling it. It's as simple as that. Well, that's an important ingredient, not just to what you think is your aspiration for the economy. So 2% real growth plus 2% inflation equals 4%. So that's what you'd expect to see in nominal income growth. And furthermore, it's an important ingredient to that calculation on the neutral rate, okay? Because it changes that natural Walrasian. There's a geeky term for you, but this was all figured out 200 years ago by Walras. Okay, so they call it the Walrasian equilibrium because this is what drives it. It changes things a lot, actually. So you can't just say, and there's demographics. Demographics are integral to that whole story, how our labor force is evolving. But in another 5 years or so, almost all of our labor force growth will be from immigration because of the things I've just described. And so, you know, that's why immigration is so important to that engine, right? So it's a critical ingredient. We have to understand all those, and we build them all into our models. And that affects our baseline. And, you know, around that, the economy fluctuates. Of course it does, but it's the baseline which matters the most to those kinds of analyses.
Thank you very much.
And here endeth the lesson. Thank you.